Okay, we're going to just get going. Just bear with me, everybody. I'm going to just very quickly run through these disclosures, and then we'll get going. I will also go on for another 5 minutes at the end, so that I know those of you who have joined don't miss out, and because you may have questions, of course. The other thing, this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product herein should not be construed as an offer to sell or a solicitation of an offer to buy in any particular market or product herein, or financial market whatsoever. Price and volume data, screen samples, and all chart patterns illustrated in this presentation are for illustrative purposes only. To add to that, we will use charts, both Forex.com charts or eSignal charts and Bloomberg charts. This webinar has been provided without regard to the specific investment objective, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss, and they're not suitable for all investors. Spot gold and silver are not subject to regulation under the US Commodities Exchange Act. Contracts for difference or CFDs, they're not available for US residents because of regulatory reasons. Okay, everyone, let's get going. We've got that out of the way. Let me just take that away. So there you go. You get to see my how I set up it's a bit of a squished Bloomberg screen at the moment, but that's how I set it up. Now just bear with me a moment. I've had a problem with my eSignal charts actually today. So today it's going to be all Bloomberg charts, if that's all right. Move that out of the way. Okay, now we're ready to go. Those of you, obviously, who are new to FX, I'm not 100% sure how many of you there are, but what I'm thinking is that a lot of you will probably have been to these webinars before. So I think that what we should do, what I should do first is just kind of run through the fact that, a lot of you will know that news and event-driven markets or events generally can really drive markets and price action. And we're in a week of huge amount of event risk. It all kind of kicks off tomorrow, really, where we have of course, the big one, which would be the FOMC meeting. We've got US GDP numbers. We've got some quarterly inflation numbers from the US as well. Added to that, we also have an ECB meeting, a Bank of England meeting, and then at the end of the week, we have non-farm payrolls. So a massively packed schedule. It's going to be really important. People are going to be looking at this to deduce just how close the Federal Reserve in the US, or the US Central Bank, is to tapering asset purchases. Also, whether or not they're going to be worried about tapering of asset purchases, or if instead what they're going to be worried about is, rather than worrying about tapering asset purchases, instead, if they're slightly more concerned about, when interest rates are going to be hiked. We're going to be looking absolutely, following that very, very closely, just to see when we can really expect things to be, when we can expect the Fed to act, whether or not they're dovish, they're hawkish, what their view is on the pickup in the labour market, but the decline in GDP. As we've got a really, really very busy week. And when you're looking at US economic data like that, like monetary policy reports and also non-farm payrolls, we're also Manoj, I'm going to answer your question in one moment. Just bear with me. But when it comes down to US risk, particularly monetary policy risk and non-farm payrolls, you've got to look at dollar yen. So I believe some people might be joining as and when. I know that there have been some problems. So good morning. Thank you so much for joining. Please bear with us. We know that there are some issues around, and just try and catch up as and when. Now, Manoj, now's probably a good time to answer your question. You said, are some charts better and more accurate than others? No, I mean, by and large, most charts now are very accurate. There's such a slight difference between, say, a Bloomberg chart and a Reuters chart, for example. I like Bloomberg. It's what my terminal is, so I get a lot of data from there. I also think our charts, our eSignal charts, they're absolutely perfect as well. I like charts that give you flexibility to change timeframes, like you can up here. Can change, you can go candles, lines, bars, whatever you want to do. You basically want a charting package, if you're thinking of getting one, that is the most flexible for you. They can, this one, for example, it allows you, or this is Bloomberg, so it's slightly different, but allows you to have lots of studies. Likewise, my Forex charts, they are brilliant, but mine don't happen to be working quite yet, quite right at the moment, but they are good. There's a very good charting system, the one from Forex.com, and Bloomberg certainly is not cheap. That is quite right, James. It's absolutely not, probably not something that a beginner trader wants to do. It's definitely much more at the professional end of the market. But my argument is it's something like Forex charts, which you can get with Forex.com if you sign up, give these charts a real good run for their money. I like why pay for charting at all? Well, this is it. You see, some providers will give it to you if you have a certain account balance. That's a good point. I think the professional end of the market, we do tend to, because we also buy the charts, but then we get a lot of other services with them as well, like news, like I can chart pretty much everything. So I literally could chart anything. If you ask me the price of hogs, I could give you the price of hogs and chart it and give you an Ichimoku cloud for a hog. So that's the reason why on the professional side we do it. But I would say, what you're looking for in a good charting package is something that is very flexible, is easy to use, obviously is up to date, and has lots of securities and studies that you can place on top of charts so that you can slice and dice that data. Yeah, James, yeah, absolutely. Bloomberg does give you a lot of information on everything. That would be good. Okay, everybody. As I said, let's get back to the FX world. Use these Bloomberg charts for all that get our money's worth out of them. But basically, with the yen, as I said, whenever you come across the US monetary policy risk and event risk, you're getting, dollar yen is the thing to watch. It's very, very sensitive to changes in monetary policy in the US, changes in yields, in particular, US interest rates. And changes in the outlook for the US economy generally. As you can see here, this is dollar yen. This is an yearly chart. Been coming off quite sharply. I just want to show you a much shorter term chart. This is just a chart over the last 2 days. We've pretty much been trading in a range. Haven't really. The first thing that, this says to me, we've really been trading in a range between kind of 98.10 on the downside, 99.70 on the downside, 98.10 on the upside. We haven't really been able to get much traction above 98.50, and we're just about clawing onto 98. So there's not really, it feels to me like there's probably a good balance of buyers and sellers here right now. People are willing to pick it up off the dip, but they're not really willing to push it much higher. Now, the other thing I want to show you in this is this. This is an Ichimoku cloud. I know those of you who join me on a regular basis will know I do quite like the Ichimoku cloud. Again, to me, it's just significant, because essentially anything above the cloud is an uptrend, below the cloud, downtrend. And look at dollar yen there. It's held on to 97.50. 97.50, a massive level. It's the base of the daily Ichimoku cloud. Pan, bear with me for Aussie yen. I will look at it in a minute. But it's absolutely massive. Especially, combine the event risk that we have out of the US today, combine that with this level that we've managed to hold at in dollar yen, and you got this potential for a big move later on. Obviously, if we get a very dovish FOMC, maybe combine that with a weak payrolls number, we could easily get through there, which would open the way back to these lows from mid-June, sub 95. That's significant. If we get above it, and if we get kind of the FOMC doesn't deliver any shocks, and we get a nice 200k plus reading of non-farm payrolls on Friday, then we could easily get above 98.76, which is the top of this cloud, and resume our uptrend. But what this really shows you is that dollar yen could be just on the cusp of the end or a cusp of a new paradigm. As you can see here from November this last year, we've been used to this uptrend, beautiful uptrend in dollar yen. That could, be a bit more challenging if we get below the cloud, because obviously life below the cloud is a technical downtrend. Now, Pan, you asked for Aussie yen, and I'm pleased that you mentioned that. Another very popular cross, especially during kind of risk-on, risk-off times. As you can see here, we broke through a key level of support here. Aussie yen really been given a battering, and it got another battering overnight. We had some weak building, housing data, building permits, I believe, and then we also had a very dovish RBA governor. That's the central bank governor of Australia. He was very dovish, spoke down the currency, kept open the prospect of an interest rate hike. potentially as early as next week when they meet on the 6th of August. And that's weighed very heavily on the Aussie. Now, what I want to show you about Aussie yen, as you can see there, Aussie yen's come under a lot more pressure than dollar yen. And the reason for that has been this. Aussie dollar. Look at that. Fantastic downtrend. It's gone from kind of 106 to 90. I mean, that's a huge, huge level. That's 16 big figures, just since April. You don't often get those type of moves. There is certainly a lot of congestion around here, but obviously what this candlestick or today's candlestick really shows you, that's a very long candlestick. There's a lot of sellers out there, who've been willing to push the Aussie lower. So this is Aussie dollar. I will go back to Aussie yen. I haven't forgotten pound. But as you can see here, we shot through 92, we shot through 91 even, managing to find 90.50 or 90.5 is acting as very good support. And then that 90 level is where kind of the support's coming in. That's where the buyers are coming in, just willing to pick up some bargains. But as you can see here, I mean, quite a low, it's a full-bodied candle. There isn't too many wicks either on the upside or the downside, which really suggests that, there's just been continual selling interest, really. Our view is that we could still continue to see the Aussie decline. And I want to show you just a slightly longer term chart. I want to look at the monthly chart as well, because obviously when you have such a torrent of decline, like we've seen, or such a fast level of decline, it's sometimes good to look at the slightly longer term charts to see if they can give us any steer, because obviously we've gone through all the support levels that we've gone through, and this kind of 88 level, just below 89, should act as very good support. That's the 100-month moving average. Obviously below there opens the way all the way to 80, but as you can see, there haven't been many situations whereby over the last kind of 3 years where we've had 3 down months in a row, and quite strong down months in a row. If anything, take a look at this section. It's probably quite similar to this move that we saw in 2008. That was a Lehman Brothers crash off. Obviously, this is much more moderate, and it's on the back of obviously weak Chinese data, the RBA cut combined with the RBA cutting, combined with obviously the Federal Reserve going the other way, and the Aussie is certainly very vulnerable. I think what this shows you is that the Aussie can look like it's really oversold, but it can continue to fall. That could happen here. I'm not going to say that we're going to go from there kind of that was basically a 4 big figure move. So that was a huge move lower of 400 points. We won't necessarily fall as low as that. 4,000 points, I guess there, but we won't necessarily fall as low as that. We could potentially, we could certainly, see sub 90. That would be our view. The other thing I want to show you, I know some of you who joined me in the past have looked at this. And this is Bloomberg. This is the CFTC data. It just measures the amount of speculative contracts out there. So these are kind of futures contracts. So these are non-commercial futures positions. This is the Aussie dollars. As you can see, it just shows that this is Aussie versus the US dollar. A lot of people have gone short the Aussie, of course, but it's started to stabilize just a little bit. So I think what's kind of interesting about that is that people are still willing, people are willing to pick it up on that dip. And obviously this is like last week's data, but there has been interest around about this 90 level. So this flatlining here kind of corresponds with, let me just show you. Bear with me one moment, guys. Corresponds, as you can see, with this bit of congestion here. So it does suggest that, people are willing, there is some buying interest around about 90. So that is certainly worth looking at, and, potentially, picking up. It could suggest that this 90 level is going to, act as strong support yet again. The other thing, obviously, let's go back to Aussie yen just to show you some levels. As you can see, this is the 50-day moving average. Very bearish occurrence happened late last week, and that was when we got the 50-day crossover the 200-day. When that happens, it suggests there's a lot of bearish sentiment, and hence we got through 90 in Aussie yen. Now, Aussie yen, as I said, it doesn't always work, and it doesn't always move in line with Aussie dollar, but it moves fairly closely. So if the Aussie dollar's declining, you can probably have a good idea that so is if Aussie dollar's declining, then you've got a pretty good idea that all the other Aussie crosses are under pressure. And indeed, that is exactly what we've seen. And it's a series, your typical kind of downtrend now, a series of lower lows. Where does this open us up to now? We've got to go all the way back. This has been a huge erosion of the move higher. Go all the way back to this kind of 87.5 level, which is the low from mid-December. In this environment as well, it's always, let me get rid of that tracker. It's always quite useful to look at the retracement level. So we just pick up this low here from kind of September to that high. There, and as you can see, we've gone through now at 89.40, just below that. We went through the 61.8% retracement of the whole up move. So that's like 2/3 of that up move has been completely eradicated, which really suggests that, what does it suggest? A couple of things. Number one, it's going to be very hard to get back to those highs of 105. Momentum does seem to be on the downside now. We seem to have entered a new paradigm. Usually Fibonacci supports, the market tends to look at them. If you get through them, then that can be a bearish signal, which could open the way, obviously, to kind of the next one, which, this 85, as I said, 85.5 level, which could come in around about, which was the lows from November as well. So obviously we have this kind of 87.5, then down to 85.5, really. They'd be kind of the next levels a lot of people will be looking at. Obviously, we get an awful lot of event risk this week. If we see the dollar kind of tank on the back of what's coming out of the FOMC and the non-farm payrolls, then maybe that won't happen so quickly. But obviously, if we get very continual dovishness coming out of the RBA, then there doesn't really seem to be too much interest to boost the Aussie right now. As I said, 90 does seem to be able to hold in Aussie dollar. We are looking a bit more vulnerable in Aussie yen, however. Obviously that breakthrough fib support is key. Watch out for where it closes actually, around about, or how it performs tomorrow. If we can recover and get back above that, fib level at kind of 87.40, we're currently trading at 88.80 or 88.90, just below 88.90. Then we could potentially just trade in this range. So do watch out for that there. Okay, the other thing I wanted to show you as well, it's not just a big week for the US, it's also a big week for the UK. As you can see here, the pound has kind of made a stab at 154, hasn't really managed to sustain itself up there. It's really kind of pulled back, but it is finding fairly good support now, or at least testing that good support around about 153 or 152.80 to 153, which is the 100 and the 50-day moving average. That could, a lot of people have been looking at these moving averages, and they could act as good support. A lot of people know where those levels are. They know that 153 level is good support, but likewise they know 154 is very good resistance as well. So this has been quite a torturous rally, really, in the pound since we had that kind of bullish reversal back in mid-July. We've been, really pressing higher here, but the buyers have come in at 154. Maybe no surprise. Just bear with me one moment. Let's go back to this Ichimoku. As you can see, we really failed to break above that Ichimoku. There's a lot of event risk. The pound is trading very, very heavily today, as we wait for that Bank of England meeting. That Bank of England meeting takes place on Thursday. I think the reason why, there's a lot of hesitancy, maybe a lot of people booking profits around that 154 level, which is really thwarting getting to this level here, which is a key level of resistance, 154.65 to 70 level, top of the daily cloud. Remember, above that would be an uptrend. The reason why people are hesitant to push it into an uptrend is because we don't know which way the Bank of England is going to go. There's been a lot of unease, a lot of hesitancy, a lot of uncertainty around how the markets decipher the Bank of England under the new governor, Mark Carney. If you cast your mind back to earlier this month, we saw the pound sell off quite sharply. As you can see here, sort of very, very sharply after Carney's first meeting as governor, when he kind of released a statement, unusual for the Bank of England, and he also said that what he also said was that that they would look at forward guidance. However, then we got the minutes out in the middle of that month and we completely went the other way. That was the same meeting. So there's an awful lot of uncertainty. It doesn't surprise me there's uncertainty at all. I think we're going to trade in a tight range, trade quite heavily into that meeting, 152.80 to 154 on the upside. So yes, James, taking a break, tanking a bit at the moment. Indeed it is. But as I said, that key level of support, really worth watching. That also coincides with the Tankan line on the cloud as well. It certainly doesn't look like we're there yet. Now, Carlos, you've looked at Euro, of course. We're going to look at Euro because, again, another bit of event risk this week. We also have an ECB meeting. Interestingly, with the Euro, we've kind of flatlined a little bit. We are trading in a range, and we haven't, compared to say what's been going on in the Aussie, what's been going on in the dollar, the levels that we've been looking at in, the Ichimoku levels that we've been trying to test in the pound. The Euro is really boring. Look at that. Very, very tight. It's very small and narrow candles. That suggests that the range has really compressed in the last few days, and indeed it has towards the end of last week. Again, that's probably down to a few things. I think a lot of people are expecting nothing really, maybe slightly a slightly more upbeat tone to the ECB's rhetoric around the economy. Things have picked up a little bit in the Eurozone of late. I think, there is an expectation that there's going to be quite, mildly Euro positive this ECB meeting. They're not going to pull any surprises. Remember, it's August. It's holiday time in the Eurozone. And then added to that as well, I think a lot of people will be sitting there and thinking actually Eurodollar could be more at risk or from whatever happens in this FOMC and non-farm payrolls meeting. And basically, the FOMC meeting, if they kind of stick to the same routine, then it could be that, we end up just trading sideways for a little while. That would be quite normal to do in Euro. We've done it for, periods before April to May here. You could argue this was a bit of a range between September and October last year. We could be doing something a bit similar, but maybe on kind of the other side. But 133 is basically capping the upside now. Hassam's just said Euro risk to the downside. It really depends. I think when there's from a currency perspective or from a markets perspective, no. From a technical perspective, no, I would say. We're above the cloud, we're in a technical uptrend. Yes, we're running into resistance. We can't seem to get above 133. But goodness, we've been giving it a good go. I think at the moment, as I said, the candles are so tight. It's so illiquid. People are picking up on the dip as well. We're trading in a very, very tight range. I don't necessarily, I think that, the risks, whether or not there's a risk to the Euro downside, I think, you have to be a fly on the wall at both the Fed and have, a preview of these NFP numbers to see that. I do think if we got a strong NFP, say 200k plus, that could really cause the Euro to decline. But we have got some good support here. Obviously 132.25 we think is going to cap the bottom of the range, certainly as we lead up to the ECB meeting and lead up to that event risk out of the US. But then below there, you're looking at kind of 130.50 to 131.10. That's this major cluster of moving averages, really thwarted the upside, and could now support the downside if we get there. So we still think that over the summer months, we're going to stay above 130. And if there is some sort of adverse surprise from either the payrolls or the FOMC meeting that is dollar positive, then we could find good support ahead of there. Just to give you kind of brief outline of what our view is for the Federal Reserve, we don't really see, too much in the way of. We don't really see too much in the way of. We don't think the FOMC can be too different. It can be too unusual, or can be too, that they can say anything too different really in their statement when it's released tomorrow. Sorry. If anything, we think that, they're going to stick to exactly the same tune, that yes, we're going to taper, but that, interest rates are going to stay very, very low. And essentially what that means is going to cap dollar upside. Now, I know that a lot of you don't trade these, but it's really worth looking at it. This is why you pay for the Bloomberg, right? You get all this stuff. Like 10-year treasury yields. Ooh, what's going on with that? 10-year treasury yields, as you can see, kind of stalling along a little bit. They've fallen back from their highs at 273, which we saw kind of towards the 5th of July, indeed. They've fallen back from there, and they've not really been able to get above 2.6% since. So what we've really seen is this yield just kind of sell off, just move down a little bit. We also have the 2-year. This is the shorter term as well. It's done kind of something similar. In fact, if anything, it's come off more sharply as it tends to. I just want to show you something as well, just to highlight this. Just bear with me one moment. I'm just going to create my own here. I can do kind of a double chart. Here we go. This chart shows the yield spread between the US and Japan and dollar yen. As you can see, that yield spread fell off very, very sharply. Now, this isn't perfect, and it has diverged massively from the yield spread, especially since Abenomics and this huge wave of stimulus. But basically, since, in more recent times, it's kind of tried to follow the same type of move. But as you can see, that spread has just turned more dollar positive, which has coincided with this. Now, the other thing I want to show you, those of you who've been trading, you know what? I'm just going to change it from here. James, you've said, have we got your own prop trade? Have we got our own prop trading desk? Yes, we are a trading desk model. I just want to show you this. I'm going to add another one. Because if you're trading the yen this week, or if you've been trading the yen for a while, you'll know this. But you'll see that the yen has had some big moves. And whereas the yen used to trade so closely with that yield spread, it's now trading so closely with the Nikkei. So, Hanson, this is why, this completely answers your question. Why is the yen gaining so much? Well, some people could argue, so yesterday it moved very, very sharply, and the main reason why for that was a bit of a flight to safety. There was a bit of the Bank of Japan governor, Kuroda, he came out and said that he really supported an increase in sales tax, to try and get the government finances on track. It sounds ridiculous, but it does make sense, really. They have very low sales tax and a huge amount of public debt in Japan, so they need to do something to collect revenue. And what we've seen is, and what we saw with that is that, obviously Japan's economy is considered fragile. So a sales tax could kind of destroy this recent recovery that we've seen. That weighed on the Nikkei heavily. When the Nikkei falls, it can sometimes push up the yen. So what we saw there, for example, today the Nikkei kind of bounced back a little bit. So we've seen the yen come just ease off a little bit. It's not perfect again. They tend to kind of up and down, following each other a little bit. But as you can see here, in fact, I'll just do the 2 days. So this is just the 2-day chart from the start of this year. Sharp decline in the Nikkei, and then then that coincided with a big rise in the yen. Sharp decline in or rise in the Nikkei today, and we've seen dollar yen gain. So again, the dollar yen and the Nikkei are having a positive relationship. Obviously, if you just look at kind of yen, I'll just go back, to that other chart. 1 second, I'll just show you, just to give you a sense of how. I'm just going to inverse that dollar yen here. Just so you can really see how they're moving in completely opposite directions. Yes. So that's, why is the yen gaining so much? One could argue it's because the Nikkei has fallen off a cliff a little bit, or because the Nikkei is weak. So if you look at Japanese equities and you're like, they're not doing so well, or they are doing really well, then it's there's a chance that maybe the yen is moving in an opposite direction, which is quite a nice relationship just to keep at the back of your mind when you talk about it. Okay, is anyone else? Are there any? Gold. Yes, Kevin. I wanted to talk about gold today. Gold has been in a nice recovery. A lot of people have said, "Is this it? Is gold doing really well now?" As you can see, ground to a bit of a halt, managing to hold up above 1300, but it's getting absolutely stuck at this 50-day moving average, which comes in at 1325. The upside so far has been just below that 1350 mark, or just above that 1350 mark. There was a sign that kind of down here towards the beginning of this month, gold was looking, obviously very oversold. There was some physical demand that was willing to push it up, but we think that it's still kind of quite temporary. I want to draw you a line, just even from a technical perspective. The fact that we're not really maintaining gains above this kind of, key resistance level is slightly worrying. Hansen says he thinks gold has more room to fall. I agree. We could potentially agree with that. Remember, we're still in very much a deflationary environment, and when you're in deflation environment, you don't really need gold because gold is an inflation hedge. Added to that, it looks like yields are rising, particularly in the US, and that just enhances gold's unattractiveness because it yields nothing. So certainly some food for thought. I do think though that a lot of gold could actually have just another could potentially have just another push higher. So Hanson, even though I agree with you in the longer term, I think it could have another push higher if the market sits there and thinks, actually, you know what, the Federal Reserve, they're gonna, they're really dovish. And we could get back to that kind of 1400, 1412 level, which is the 100-day moving average as well, or the green line on this chart. And I see us really kind of range trading. I do think 1200 is probably the low, even 1220. Right now, I think in the very short term, so the next 24 hours or so, we're going to trade in range with kind of 1305 on the downside, maybe 1330 to 1340 on the upside. I don't see us extending out that range, not until we actually get the FOMC, even though I think the FOMC is probably not going to be the most important release that we get this week. I think the non-farm payrolls probably will be. Pan, very last question now. I'm going to look at CAD. Dollar CAD has come under pressure. It's managing to find some support here now at this 100-day moving average at 180.70. It's been strong GDP could push it down too. What, gold? Yeah, potentially it could, but GDP is going to be a funny one this month because of a lot of revisions. So it could be, to me, the payrolls is much more timely. I prefer to concentrate on the payrolls, but I agree with you, GDP is still going to be an important release. This 100-day moving average is capping downside in dollar CAD. We seem to have picked up just found our feet a little bit here. I'm just going to open Brent crude oil quickly, because obviously we've had these problems in Egypt. Problems flared up actually in very close. Problems flared up very close to the Suez Canal, obviously a big transportation route for global oil supplies, and that's kind of not had too much of an impact as Brent has fallen off. Yesterday we saw kind of, oil try to get back above this 200-day moving average, a key level of resistance on the back of the Egypt protest. They calmed down today and we backed away from there. We're looking very toppy. It looks like 110 is kind of a more medium-term low. Obviously WTI is slightly more interesting at the moment. Pretty much narrowed fully. It's had a massive amount of it. It had narrowed its difference, or the difference between it and Brent quite sharply. But right now it's declining more sharply. So it's through that 105 level. There's a few things that weigh on the oil price this week, which is going to be, the prospect of weak growth out of the US, maybe. Obviously weak growth out of China. A lot of people were looking at that. Why is oil doing so well when China is so weak? That could potentially cap CAD gains. And as I said, it's no wonder when the oil price is just taking a breather, pulling back a little bit, that we're seeing dollar CAD do exactly the same. 103.60, this 50-day moving average, that is your near-term resistance ahead of 104. Again, whether or not we break above this 103.60 to 104 level will all be dependent on the Fed, on those, and also on those payrolls, which, as I said, I see them as being slightly more important, slightly more directional, because I don't see the Fed telling us anything we don't know already. Okay, everyone, thank you so much for joining. Please do join us next week. It's been great to have you guys here, and for you to join it and give us all of your questions. Really, really useful to see you. Thanks so much again, everybody.